Hey guys, thank you so much for your patience. Sorry about that. We had some technical difficulties. Just want to welcome everybody to this evening's event. Tonight we're going to be diving into the amazing market of San Antonio. As you can see, we're going to be discussing the many ways this market is affordable, growing, and yet still cash flowing. That is a hard combo these days. This is a topic and also a market I'm very passionate about, and I'm excited to dive into it with you all. So with that said, here's a quick intro. For those of you I haven't had the opportunity to connect with, I see a lot of you that I know on the call tonight, but my name is Rachel. I'm a realtor and an advisor here at Marshall Reddick. I grew up just outside of Seattle and then moved to California for college. And then last summer, my husband and I packed up everything we had and our two sons, and we actually moved across the country to Texas. So, well, halfway across. So we are officially Texans now. I have my BA from Vanguard University. I'm a licensed realtor in both California and Texas. And I'm a huge believer personally in Marshall Reddick and our many amazing services. In fact, my husband and I were actually investors for many years before I decided to come over and join the team. And I just really love my clients and my career here at Marshall Reddick. We have an amazing privilege just to be able to help people all around the world build their wealth through our services. So that's a little bit about me. Speaking of our services, we do have multiple facets that comprise Marshall Reddick, a little bit of something for everybody. We are a real estate brokerage, so we help our clients buy and sell residential real estate. Some of those clients are buying their primary residences in any of our markets or a vacation home. Some of our, say, our California clients that want to buy a house in Florida or vice versa, or any combination of the above. We also have others coming to us for our one-stop shop investment property services. Kian and I do a lot of those transactions together. We're going to dive into those later. And, you know, investment property services is what a lot of our clients come to us to learn about. That's actually how I started my journey here at Marshall Reddick. We are also a private money lender. So we help a lot of our clients by providing private money loans to help fund a variety of programs. On the flip side of that coin, we actually have investors that fund those individual loans as investments as well. So we also have our Marshall Reddick Fund, which is available for accredited investors. The fund is an incredible passive income option for people that do qualify to be able to participate. I'd be happy to chat with you offline about that later. That's a whole different section. So lots of different things. We have a little bit of something for everyone. We also have incredible property management services in all of our primary Marshall Reddick markets. If you are investing with Marshall Reddick in for an investment property, most of our clients are doing that long distance. So you obviously absolutely want to have a property manager to take care of that property for you. And you will learn very quickly, if it's your first property, that your property manager can make or break your success in this business. So it's absolutely important to have a team that you know you can trust. And I can definitely speak to the incredible services our property management team has, as I'm also a property management client. So as you can see, our team, myself included here at Marshall Reddick, we really believe in the services that we offer. I'm a client in every single one of these areas, and most of my partners are as well. So it's a pretty incredible company with a little bit of something for everyone. Okay, so as far as our markets go, we have a presence in 16 major metropolitan markets across 8 different states. Of these markets, our primary Marshall Reddick markets are California, Central Texas, Southwest Florida, Tennessee, and Oak Grove, Kentucky. So clients come to me every day and say, Rachel, how does Marshall Reddick select the markets that we're in? That's an excellent question. It's extremely important to the health and stability of any thriving real estate market that all of these facets are covered. So first and foremost, a strong job market. That's very important and very basic to any strong real estate market. Number 2, low vacancy rates. We want to make sure that the properties that exist in this market have low vacancy. There's a demand for housing, and keep the vacancy low. Economic diversity. We don't want to be in a market where anyone's too heavily dependent on one industry. We like to be in major metro markets that have a variety of companies, jobs, job basis, so it's not tied too much to one particular industry. Housing affordability, that's a big one. That's why Marshall Reddick has chosen the markets that we are in. You can get amazing properties in great markets at an affordable price still. Are they landlord friendly? More than ever, especially given the events in the world the last couple of years, this is so important. You want to be in a market that the laws are in your favor as a landlord. If you're in a tenant friendly state, that can really come to hurt you if you have a tenant that becomes a problem. You want to invest in landlord friendly states. I would argue that might even be the most important thing. Strong education. We like to have markets where there's lots of good education options, lots of different education colleges, different schools, all sorts of different things, as well as tenant bases that have good education as well. And like I said earlier, reliable property management, that is a must. You need to know you have an advocate there to take care of your property when you're there. So you just have to deposit your checks. That's it. Okay, so now that we've covered all that, it is my pleasure to officially introduce you to my partner, Kian Oros. Kian is incredible and extremely accomplished. I work with him all the time. We probably talk, I don't know, many times a day. He's an amazing asset to our company, our team, and especially his clients. And I know you're gonna love everything he has in store for you tonight. So with that said, Kian, I'll turn it over to you.
Thank you, Rachel. Thank you guys for joining today. I'm excited to talk about our market with you and share a little bit about our team, our processes, and myself. So I have, of course, I'm a licensed Texas Realtor. I started in 2017, so I've been in real estate for about 5 years, which is about as soon as I could start. When I first started at Marshall Reddick, I came on as a leasing agent. I was one of the first leasing agents that they had here. So that gave me a lot of good insight in, of course, different areas, what kind of tenants we see, what they do for work, where they commute to, and what they really value most, which areas are most successful for rent increases, all of that stuff. So that was really my stomping ground when I first started here. And that gave me really good market knowledge to go on to really focus on investment sales. So that's what I do now. That's what I've primarily done the last 18 months. So I just do sales here at Marshall Reddick and just do investment clients. Of course, we can always help primary clients as well. And we do have primary clients from time to time locally, but we do fixate on investment buyers in our market. So last year we sold about 72 properties, investment properties. This year we're already contracted and sold just here at, gosh, we're January 12th, and we're at 25 contracted and sold for this year already. And a lot of that is some of our new construction options that will be closing now in the first and second quarter. So very exciting to get off to a really great start here. And I'm also a lifelong Central Texas resident. So I've spent majority of my life in New Braunfels, which we'll get into here if that doesn't ring a bell. And then I now live in San Antonio. I've also lived in Dallas for a little bit. So I have a lot of roots here. Most of my family lives here. And it's probably where I will live the rest of my life. So I, of course, have a lot of knowledge, local things to do, stuff like that. This is the team here, our San Antonio team. So we've grown so much in size the last few years. When we started just about 4 to 5 years ago, it was just about 3 or 4 of us. Now we're a team of about 30 plus. We have a great property management team consisting of tenant coordinators, owner coordinators, accountants, maintenance, property managers. And then we also have our great leasing team and then the sales team. So like I said, we're about at 30 now and we're growing. It's so important, like Rachel said, when hiring a property manager, it can make or break you trying to leverage properties and grow your portfolio. You want to have a team that has a successful rate of growth. The mom and pops that are in every market, can't always sustain you growing your portfolio to 5, 10, 15 properties. So to go from 200 several years ago to about 1,000 where we are at today, that takes a lot of knowledge on the market, a lot of hires, a lot of vetting, and so we have a good success rate here. and super important thing when you're hiring a property manager. So this is the sales by office for the several areas that we're within for selling real estate. So various parts of the Bay Area. We also have Florida, which is Cape Coral, Clarksville in Tennessee, and then San Antonio. Also, we have a presence in Los Angeles and Orange County. So you can see here that San Antonio really took the cake for the majority of the sales that we did for our company. And a lot of that is, you can attribute that to repeat clients that we have. So we have probably the highest amount of repeat buyers here in Texas. And that's just, we do well with the properties and they see the values go up. They keep us in mind to buy the next one and the next one and the next one. So we've had a lot of success here. This is for 2021, and we hope to continue that on trend for 2022. This is, of course, it's great to know who you work with and our track record and our sales volume, our reviews. So this is from Zillow. This is our team as a whole. The last 12 months have done 174 sales. On Zillow too, that probably doesn't even account for everything because some of the new construction data doesn't always get reported. We really pride ourselves in a good client experience. So we're always asking for reviews. It's a lot of the great realtors in our office. A lot of them I work with alongside here. So always an important thing to look at. This is the team that I have here. Of course, like I said, we just fixate on investment sales. A couple of the people that I work with, who've worked with me in the past, maybe these names will ring a bell. Jonathan is my head co-agent, so he helps me with a lot of the clients, the processes of identifying property, developments, running the numbers, rental reports, all of those things that go with the pre-contract process of really vetting great properties in our market. And then we have our transaction coordinator. So when we go under contract, it is a careful process from start to finish, carrying you from getting that property in escrow all the way to closing. So Sean is a great resource and helps our team really manage that pipeline. And then we have Alexis, who is a great leasing agent. She leases most of our properties. She's also out in the field doing a lot of our video tours, our inspections, meeting with contractors, getting bids at certain properties. So we have a full service team here to help with any of the investors we have anywhere in the world. There's such a great resource to me as well. And it's good to know that you have a team that you can access at all times. Unfortunately, I'm just one person. If we can ever clone ourselves in the future, I'll be the first to sign up for that. But in the meantime, I'm always happy to work with like-minded people. They are very talented, and you're given access to all those people when we initially meet on our consult. That way, if I'm in a meeting or out in the field, there's various people within my team that you can reach for details on investment properties or any opportunities that we're sending you at the time. Everything under one roof, like as she mentioned earlier, we take everything from start to finish. So a lot of our investors are out of state, and that's super resourceful because maybe you're, in a metropolitan that's very unfavorable to buy. So when you're identifying these areas that you feel very strongly about, you want to make sure that they can really take care of everything. It's expensive to travel to various places, back and forth, plane tickets, travel, meals and everything if you were to have to be here the entire process. But again, we have a lot of out-of-state investors. Many times don't ever come here and through the process. Of course, we always welcome our clients if they want to come during the inspection period, or they even want to come before even finding a property just to scope out different areas. So we do have that approach available, but we're well equipped to take all of the due diligence up front and under escrow to fully vet a property for you from start to finish and take it from the sales to the leasing all the way to the management and you getting your first check. So it's very important to know that you have a team here and in all of our markets that can do that. This is the fee structure for our property management here in Texas and what we charge based on the property that you're going to purchase here. So Our lease renewal fee is $150. We don't have a lot of fees, so we don't have an initial setup fee, don't have a maintenance coordination fee, eviction coordination fee. This is all included, of course, in your percentile that you are charged monthly with Marshall Reddick. So, our single family home is 8%, duplexes and fourplexes are 7%, and anything past that is going to be 6%. This is our units under management. So like I said, in all of Central Texas, we're talking about Austin, New Braunfels, Seguin, San Antonio. We're ranging about 950. So we're very close to about 1,000 at this point. With a bulk of our properties being in San Antonio and New Braunfels, that is the main amount of inventory that we have. These, of course, areas are really great for the purchase price, great schools, great things to do, Job Corps. So we'll get into the details of that, but this is kind of an aerial view of where you can see a lot of our properties are at currently. So you can see for San Antonio, a lot of the inventory stays on the north side. This is the areas, from managing over 5 to 6 years that we've known to be great, a great return on investment, great tenants in these areas, great appreciation, as well as New Braunfels and Seguin. So this is really what we stick to for the most part. But we'll get into some of the details here. So why Texas and why Central Texas specifically? So Texas in general is the second highest population state in the country. It trails alongside, of course, California. I think third is we have third and fourth is Florida and New York. The price points for all of those is much higher, especially for New York and California, but even Florida shows up a little bit from the average home price here, especially in Central Texas. So to have the infrastructure in place, the population here, but still have the purchase price be very affordable, it's a great thing. Texas is super landlord friendly, which, like Rachel said, comes really in handy in the worst situations. So, when you have tenants not paying on time, several months can go by and you can see no income. And if it takes a process of several months to a year, 2 years to really get a tenant out, that could be make or break on an investment. So here it's very easy to evict. We don't have a current moratorium in place with COVID. Of course, we're always updating our clients if things change, but that's where things are currently at with Texas. The good thing about being in several markets through COVID is we were able to see what markets had the lowest default rate. So our market here in San Antonio took the cake on that. I think it never went above 5 to 10% for our market here, even in the worst parts at the start of COVID. And you can attribute a lot of that to the fact that San Antonio is the military city. So we have the biggest military population, biggest government worker population, and biggest veteran population. So that is great because in most military government positions, you're going to have a guaranteed check. Those people are going to be taken care of very well income-wise. So they're usually going to, especially military that lives off base, they usually have a housing stipend. So for that reason, rent's going to get paid. And we saw that in the numbers through 2020. So that was a great thing as well. Central Texas has a very diversified workforce. So like I said, San Antonio's main job corps is military, but it also takes the cake for all of the metropolitans in Texas as being having the biggest medical center. So we have, we'll get here in a little bit, but it's Methodist Medical. And that is the biggest, most amount of patients, most amount of revenue medical center in any metropolitan here. So that's a great thing. Of course, Austin is a big tech capital. I'm sure many of you know a lot of Silicon Valley moving or building presence in Austin has created a lot of tech opportunities there. And even that's felt here in San Antonio and New Braunfels. We'll talk more about that later. But the main thing is with tech, and what makes it interesting going into the future is that a lot of people can work from home. So people don't have to live in Austin. Maybe they commute 1 or 2 days a week and they live in New Braunfels or Seguin or even San Antonio. These usually at furthest East San Antonio to South Austin is about an hour and 20 minutes. And of course, the closer along 35 you are, like New Braunfels, it's only about a 45-minute drive. So tech, even in Austin, if you're not looking to buy there, it's felt in this part of the market as well. We also have a lot of industrial work in Seguin. So we have a Caterpillar plant out there. We have a Tyson plant, lots of oil field jobs around that area of Texas. So it's a very diversified market for Job Corps. That's good because you don't want to put your eggs in all one basket. To be in Central Texas, there's a lot of different job opportunities. That means it's pretty strong to move forward in the future on appreciation in home prices. And then you can see a little bit here the last 10 years of how the population has grown in each metropolitan. So we have Austin metropolitan growing a little bit bigger, but San Antonio as well was about 12%. New Braunfels in particular, the last 10 years has always made about every top 10 list for highest growth rate of any city in the country. So New Braunfels is considered San Antonio Metro and has had a really steady growth rate the last 10 years here. This is the map here, kind of to show you aerial view of all the cities that we're talking about. So this is what we call the Texas Triangle. A majority of all Texas residents, let's say probably 70 to 80% live somewhere in these metropolitans here. But this is the area that we cover, so mainly Austin, New Braunfels, San Antonio. And this is where a lot of the growth is that we're seeing. This is the average sales prices amongst the different metropolitans. So you can see San Antonio, New Braunfels is the most affordable right now and more balanced with the rental market here, as opposed to some of the other markets that have higher populations, have been around a lot longer, or well into the threes. And Austin is almost about at 500,000 average home price for Austin Metro. And that's very important that the biggest metropolitan in really at this point for home prices is Austin, because that's right next door to San Antonio, like I just said. So home prices being at almost $500,000 and still San Antonio being at 288, you can see really where prices are going in this area. And so this is just kind of to give you a feel for where average single family home prices are. This is the population of each area. So you can see Dallas and Houston are about 7 million, and then combined together, San Antonio and Austin are about a little bit below 5. So there's still a great amount of room for growth here. As these areas start to expand and kind of merge together as one. We saw this, decades ago with Dallas and Fort Worth, is that as these areas grow, they eventually merge together, and we just have Dallas-Fort Worth Metro. San Antonio and Austin will be very similar, and everything along it will kind of start to mesh together to one. And maybe, as time really stretches along, the whole Texas Triangle will kind of do the same thing. But kind of here in this market, that's what we're seeing. This is just to nail the point that I was saying earlier about medical presence. You can see here Methodist Hospital, San Antonio. Also, San Antonio is #1 and #5 for these hospitals here, these medical centers. So again, a big medical presence in San Antonio that not a lot of people always expect. Now, a lot of people ask, what's the difference between San Antonio Metro and Austin in terms of investment numbers? So San Antonio is the lowest cost index, lowest cost of living of the metropolitans in Texas, and most balanced with rents. So that's really important when you look at where the rental market is versus where the sales prices are. That's what I mean when I say balanced market. So a lot of these other bigger metropolitans like Austin, Dallas, and Houston, sales prices has started to far exceed where rents are or can go anytime soon. So that creates a situation where it's very hard to buy in. It's very hard to balance for cash flow. So you would, unless you have a large amount of capital or you're a cash client, you're kind of out of luck for some of those metropolitans to get your foot in the door, because it's, you'd be in the negatives for 25 to 35% down for those areas. Here in San Antonio, even at as low as 20% down, you can still be cash flow positive, which is super important. So there's a window closing, of course, because as more and more residents move to Texas, we're going to see that that's not always going to be the case, even for San Antonio. But at this moment, we still are cash flow positive for all of our A, B, and C class options. As I told you earlier, San Antonio is well known for having that government and military presence. That creates a very steady growth pattern because a lot of government pay slowly is adjusted with appreciation every year. Having a market that's dictated by, tech like Austin, it's a little bit more volatile. Markets like that have the ability for people to work from home or eventually, move their presence to other cities in the future. But San Antonio has long been the military city, and that has created really firm home prices and rent increases over time. San Antonio also has some of the lowest tax rates. One of the things that hurts Houston at least is that it's the highest tax rates that we see of any metropolitan. Here in San Antonio, it's usually about high 2s to low 3s. A lot of the infrastructure in these bigger cities, usually you'll see those tax increases with the tax rate. But here you have more affordable sales prices, affordable tax rate, and honestly, a lot of these areas have better schools. So you're really kind of getting more bang for your buck in these areas. Both Austin and San Antonio, Central Texas in general, is, I would say, disaster resistant, not disaster proof, but you can argue nowhere on this green earth is there anything disaster proof. But it being so far inland, we don't really see a lot of disasters. Dallas is in the tornado belt. And then also Houston is along the Gulf. So some of South Houston, of course, has higher insurance rates that you'd pay there, risk of hurricanes, flooding, things like such. But here in Austin, San Antonio, we don't really experience that. We do have crazy weather, but nothing that would be a detriment to an investment property. So here's a good look at cash flow versus appreciation across Central Texas, and kind of a point that I'm trying to make on really identifying good areas to invest in and watch that build over time. So we had a duplex option that we've sold many times before. You may have seen it on our website, but it's a A-class new construction duplex, 3-bed, 2-bath, 2-car garage, very standard, and they built it all over Texas. But in about 2019, we had these various communities that were all the same builder, all the same product. So you can see here, as it was selling in Buda, it was about the 370 price point. New Braunfels was close to about 360, and Seguin was 345. So this was before COVID. This was also a little bit before the big Austin boom that has occurred really since 2019 and on. But that small increase with Buda, you saw the amazing amount of growth there from 375 to 570. This was a recent sale that we actually had with a client in-house. It was about, this was a 2-year turnaround of making almost 200,000 plus in appreciation just in that amount of time. And I say it's important to really identify an area and what it brings to the table, because not a lot of people had their eyes on Austin at the time, or even then thought that maybe 375 was too much for Austin. And we kind of get the similar feel with some of our clients with New Braunfels. And a great thing I love about New Braunfels, and maybe I'm a little bit biased because I'm from there, but it's a great area for appreciation and cash flow. New Braunfels is great because it's nestled almost in between San Antonio and Austin. So it's along this I-35 stretch that will take you from the border of Texas all the way up through San Antonio, Austin, all the way up to Dallas, in Oklahoma. So it's a big main artery of our state and where a lot of the growth is. New Braunfels, like I said, is almost right in between, but it's closer to San Antonio. So it's about a 20-minute commute from New Braunfels to the start of East San Antonio. It's about 45 minutes to South Austin. So we do have a lot of tenants that commute as well. Like I said, the interesting thing about Austin is it's tech-based. So a lot of people who maybe don't want to live in the city or maybe want to rent more and get more for their buck, would rather live in a suburb kind of like New Braunfels. And if they only have to go to the office 2 to 3 times a week, it makes perfect sense. And it's not really that hard of a drive, especially a lot of these big tech companies. There is some in North Austin, but there's even a lot more in South Austin. So to be kind of right in the mix of all of that is super important. But again, when people kind of fixate their entire investment strategy on cash flow and really neglect the area and overall appreciation over time, they miss out on money. So the cash flow margins for this Buda duplex, when you purchased it at 375 versus 345 for Seguin, it cost you almost about $120,000 from where this value is here now in Seguin and where it's at New Braunfels. So I think a good opportunity now, if you had your pickings of where a large amount of appreciation is going to go as that Austin bleed over happens, is going to be really now fixated between New Braunfels, Schertz, and Cibolo, which is this kind of stretch right here along I-35. We see Seguin as another good opportunity as well. Seguin's always good to get your foot in the door because it is a little bit cheaper than New Braunfels. And we see a lot of great cash flowing properties over there. But if your long-term goal is growth, you have to think about that. So this is a real life example. This isn't just me throwing out numbers. These are real duplexes that we've sold over the last 3 years and where they're at today. So just kind of to give you a visual on the difference of an appreciation-based play versus a cash flow-based play and what's on the table here. So now we'll go to A class versus B, C, and D class. So since I've started, I've sold pretty much A, B, C, and D, everything you can think of in all parts of Central Texas. So I really know what works best. I always try to give clients the best advice I can. Some clients, of course, want to go with really what they feel is best. But this is a bit of the experience that we've seen over time. And A class usually always fares better in the long term. So here's a few of the points kind of to go through what makes A class a better investment over time than the B, C, and D options. That's usually the options that we see a lot of these blogs push, a lot of these podcasts. You have to keep in mind that a lot of these people out here, they're not in the field, they're not selling the property, they're not leasing the property, and their experiences may have gone way back to 2015, 2008. And the market changes, so those same rules don't apply. And again, their experience isn't always ours, which is managing, leasing, selling, really doing a lot of the heavy lifting of these investments. We can best tell you really how each area, each type has turned out over time. So variable expenses, which we'll look at an example in a second, are much higher risk with the lower class properties. So when you're picking a property, it's going to come with maintenance at some point. You're holding 5, 10, 15, 20 years. The time that you purchase it with a new construction may be very minimal maintenance, but even that property is going to have some over time. But at least with a new construction or something that's very minimally not old, so a few years on it, the clock has just started. And you have a stronger predictability because it's been built to code of the construction advances that we have today. But the further and further you go back, the more variables there are. And even when we do our due diligence on a property, you're not going to see every single thing with it in a 3 to 4 hour inspection. There's things that just come about later on that's going to eat into your cash flow. And that's not to say that there isn't great opportunities in the past or in the future for fix and flips or for B and C class properties, but overall, it's usually going to eat more into that cash flow, even if it looks like it's a better steal up front. Another point is contractors, subcontractors, time and material in the age of COVID. These are issues that were, coming a while back with not having enough people in these trades, material shortages, but COVID kind of just propelled everything forward. So even as a management company that's constantly identifying new contractors everywhere you can think of in every trade. We struggle to really find the work, affordability, to really make a lot of these B, C, D class properties work. And it's a different game than even 2019 and before. It's not to say that there's not an opportunity in the future again for those properties, but it's better if you have the capital now and you want to get in with an A class. Let that property appreciate as it will. The rents will increase too. And when the time's right and the market's right, and maybe those opportunities are more fruitful, and we've fixed a lot of these issues, you can, cash out refinance, you can HELOC, and you can move towards those strategies because those homes, the older inventory, it's not going anywhere. Older inventory is here right now. It will still be there in a few years, and then there's inventory getting older all the time. Constantly moving forward, never moving backward. So those opportunities will be there. But at this moment, these supply chain issues do really make it hard to make money on those, like maybe, as opposed to 3 years ago. It will not cash flow as much. Even this was a point that I was making earlier with properties that maybe are lower on the sales price, and where they are with the rents, the cash flow looks really great. And what a cash flow versus appreciation play will look like. So always usually what I see people move towards B and C, D class properties is the cash flow, the affordability. It's usually a lower price point. But again, just to kind of go back to the last slide that we had, let me see here. You can see that a cash flow play, if you were looking for the most affordable property in the market, kind of like we can see with this model, and them being all the same product, over time, the appreciation-based play is what made more money in the long run, which maybe not everybody's strategy is the same, but a lot of our investors come with us for wanting long-term growth. So the A-class option, again, is going to win there. B and C D-class properties, of course, like I said, with my leasing background, the rents are not going to increase high when we have these areas that maybe don't have the greatest job corps, don't have the greatest schools, safety, quality of life. There's tons of areas in San Antonio, Austin, any metropolitan is going to have these areas that don't do well and are unsafe and aren't going to be good rent increases, and they're going to have high tenant turnover. So, from being in the market so long, we know those areas very well, and we try to stay clear of those. So again, people get lured in by the great cash flow that it looks on the deal, the easy purchase price amount, but it can be very deceiving because you're not really projecting in your mind, hey, maybe this tenant can stop paying. And it could be, even here in Texas, it's easier, but it can still at longest be a 2 or 3 month process to get a new tenant in there. And if you go right back to the next tenant for that area not being great either, you're just right back at square one. So just another reason why it could be detrimental for the lower class properties. These are a few metrics on the San Antonio market over time. You can see there's been a pretty steady increase. Last 25 years, if you look on our website for our market, it's been very fruitful. Even around 2008 and 9, it's pretty much about break even for appreciation. So as these other bigger markets, Dallas, New York, Phoenix, these different bigger metropolitans all around the country took a pretty hard hit because they, had higher purchase prices. Here in San Antonio, it stayed very affordable. And it stayed pretty much break even. And about since then, it's been on a steady increase every year. Our average appreciation is now to about 4% year after year, but in recent years, of course, it's been a lot larger. I don't suspect that it's going to be pretty small for appreciation again. Just we have a lot of supply chain issues, not enough new construction in a lot of these areas. So that's, of course, what drives supply and demand and prices. So until that happens, chances are this graph is going to far exceed to about 300, maybe even middle threes to low fours before we start to see lower appreciation markers here in Texas. So these, of course, are some rental market stats. So you can see the average rent's about at $1,700 for your average single family home. For new construction, really A-class properties, we're even seeing 1,800 to 2,000 in places like New Braunfels and Schertz. So rents have really gone up this year. And it's great, like I said before, to be in a balanced market where you have a balanced amount of primary owners, a balanced amount of investment properties, and there's a balance between rents and sales prices. To have one or the other creates a disrupt in the market for several reasons, but it also wouldn't be a good investment for you to come into a market that's a majority renters, or the sales price is astronomical and it's in the negative cash flow for you. This is our market packet, so we'll send you guys this information, of course, after the webinar here, but this is also on our website, so if you want to check it out, it kind of shows you more in-depth stats. I don't want to draw on about numbers all day, so we want to get to some specific property picks that we have on the market right now. But if you want more data for a market, this data packet will kind of give you the most up-to-date figures on our marketplace. One more thing, I know we've been talking about a lot about San Antonio, New Braunfels, and Austin, because those are kind of like the big siblings, you will, of our markets, and Seguin's a little bit of the smaller one here. It has the same good proximity as New Braunfels. It's about 20 minutes to New Braunfels, 30 minutes to San Antonio, and about an hour to Austin. So it still has that great proximity that New Braunfels has. And it's a great, to me, second option because New Braunfels is very low in inventory. Seguin also has a great job core. So like I mentioned earlier, a lot of different industrial fields there and oil work. They also have a very prestigious university, Texas Lutheran. So Seguin is steadily increasing for sure, and price points are very affordable. You can see here, cost of living index, Seguin takes the cake here. It's very expensive in markets like Austin, Houston, and Dallas, but New Braunfels, San Antonio, Seguin stay very affordable. Again, great to be in a balanced market. You can see here a lot of the different developments that we've had in Seguin from 2020. So there's been a lot of growth here for single family home builders, duplexes, everywhere from KB to Lennar has really started to put roots in Seguin. Like I said, New Braunfels has become pretty high in price. And Seguin's a great second option because it has, again, close to the same proximity of what New Braunfels has. So here's some handpick options that we're going to go over really quickly for things that are available at the moment or coming up here. So the first one we have is Sydney Cove. These are some duplexes. We have about 20 to 21 of these duplexes in Schertz. So really great product, brand new. They have the 2-car garage. We have 3 different models. So we have 1 story, 2 stories, 2 different 2 stories. And so we have a few options here, but you have the good tile flooring, you have the granite countertops, stainless steel appliances. So it's really turnkey and ready to go. And it's separately metered as well. So you do not have to take care of the water bill, the electrical bill, which of course, great cash flow for you because of that. This is where Schertz is. So like I said, a big proponent of where I think the next big boom is really in this stretch here of New Braunfels to Selma, Schertz, and Cibolo. We see a lot of commercial presence along I-35, a lot of growth from other single family home builders in that area. Schertz is very strict on allowing multifamily. So because the inventory is so short there, it really drives up rents. So we have pretty good cash flow on this one. I also myself invest in Schertz. I have some land there, so I think it's a great area to be in. And you have the military base right next to you. So this is actually Randolph Air Force Base. It's one of the biggest bases that we have in San Antonio. So that also creates a really good job core to be right next to. But again, just a great area overall, and it's pretty rare to find property duplexes in Schertz. So it's not an opportunity, after we sell these 20 duplexes that will probably come along for quite a while. Even pre-owned inventory, we don't really see it in Schertz. The city ordinance and all these different subsidies that you see have their own codes and regulations for allowing multifamily. So that's, really what controls how much inventory will be allowed for these types of options. So this is the figures on this duplex. So you can see right here that the total cash flow is about $550 monthly, and this is on a 30% down. Purchase, if you were to do that with closing costs and everything on the sales price, is going to be about 152. I believe it's about 120 if you go down to 25%. And you're still cash flow positive even at 25% with this one. Again, whatever your financing is, when we're connected, we'll always curate these types of sheets and these numbers that we run based on your financing, but this is on a 30%. So a little bit, just a really quick rundown on variable expenses. So this is kind of what is dictated by A, B, and C class properties. So these figures right here that you see, mortgage payment, taxes, insurance management fee, these are things that are fixed expenses. You're gonna have to pay them probably every month, every quarter, maybe every year. And usually they're not gonna change besides your taxes. But what we see is rent increases usually far exceed tax increases. Here in Texas, tax increases are capped locally. So usually they can't go above anywhere from 8 to 10% based on the local, appraisal jurisdiction. But here, these are variable expenses. So these are things that you should save accordingly for as a landlord. And you can call these rainy day expenses, things that you should save if it goes vacant, if you have some maintenance in the future and you have to release it. So in properties like this that are A class, they're usually going to go vacant less because we're going to see the tenant renew year after year. And the maintenance is going to be pretty minimal because it's usually a newer option or it's very well updated. So the average that we're having you save for an option like this would be 5%. And even when you save accordingly 5%, you're still left with 129 monthly. So the goal of these properties is that once you really do this investment capital of say 152, that you never have to pay an extra dime if you save accordingly. This is not something that Marshall Reddick puts aside for you. You're making $550 a month, but it's up to you whether how much you want to save. You may say all of it, you may say none of it, but this is, we factor that into what you should expect. So the vacancy is about 5%. That I believe is about 21-day vacancy a year. But if your tenants renew for the next 5 years, you just pocket that. And for new construction, especially that has warranties in place, you have very little maintenance. So another good thing to save accordingly, but to pick good options that aren't going to eat more of that, because these variable expenses is what starts to eat at these numbers. So you'll see a B or C class property, and it'll be very high. Maybe this would even be 1,000 for a B or C class, but these are going to be so high for the amount that you're going to save that really what you're left with at the end of it after several 3-4 years is in the negatives. So what was even the purchase of the point of going for the lower options in the less good of areas when overall it didn't even cash flow what you really purchased it for. So this is the metrics on this one. The next one we have is Jefferson Place. This is in Seguin. This one does not have the garages. It's a little bit bigger on the square feet, so it's a 3-bed, 2-bath. These are just 1-story duplexes. They have the modern gray color scheme on the inside, granite countertops, stainless steel appliances, white cabinetry, and they do have at least about 2.5 spaces on each side for parking. And you do have the xeriscaping in the front, the sod and the sprinkler systems in the back. These options are a little bit more affordable because of them not having the garages. So these are going to be at $430. So you're a little bit at you're about $138 for 30% down. And these have about close to the same amount of cash flow. I think the other one actually had a little bit higher. We have about 45 of these duplexes that we're selling from now to the end of the year. So these are some good options as well. Just to get your foot into the door. Like I said, we don't immediately have a lot of inventory in New Braunfels, so this is a good second best to getting in there. We don't have any developments there at the time. And, if you're looking in New Braunfels for multifamily, it's really just a waiting game. And we usually do have to go over asking. So you can sometimes be waiting 2 to 3 months to really find that good opportunity for us to secure it, rather than maybe secure something now, allow, the market to appreciate and this to go up. And then eventually, maybe when there's a good development that you like in New Braunfels, you can equity out money and you can go for it then. So this is another good new construction option that we have. The last one is a single family home community. This is Savannah Place by LGI. This location is kind of in the Schertz Converse area. It kind of lies on both sub-cities of San Antonio. This is a great community. We have about 6 or 7 different rentals there. Right now, my parents actually bought in this neighborhood, and it's been very good for the appreciation in rents over the last year that they've owned in this community. They have a splash pad, they have trails, a community center, and they also have a really nice entrance and some trails as well. So it's a really great community, and it's pretty low for the purchase price. Again, if you remember a few slides back, the average sales price for a single family home for most of these metropolitans is high into the 300s for a lot of Texas. So this option for their 3-bed, 2-bath is at $274,500. So if you are lower on capital looking for a single family home option that is A-class, this is a great option for you. LGI, of course, a lot of these builders have their in-house lending option, and so they've been pretty good. The options that they have right now cover your closing costs. So, of course, this is with closing costs, but if, you did go for that option, you'd be even less for your investment capital out of pocket. This one is close to break even. Now, one thing to keep in mind, single family home options typically appreciate a little bit higher than duplexes and fourplexes and so on. And a lot of people don't always get why that is, but it's usually because single family homes are going to be higher to appreciate just because of the buyer pool. So the buyer pool here in Texas and what people primarily look for is single family homes, the privacy of it, the neighborhood appeal, the areas, and of course the schools, amenities that come with it. Typically they're not getting that with multifamily as much. So those options will appreciate accordingly. We've seen tons of duplexes we've always sold through the year appreciate very close. But the single family home option will always take the cake. So the cash flow is going to be more minimal, but over time these options are going to go further. So like I said, this is kind of the sales prices where Austin was about 4 years ago, to kind of the low 3s, and now they're about low 5s. For a lot of those single family homes there. So our market usually follows behind Austin by about 4 to 5 years. So it's still a really good entry point to lock in sales price, of course. And that cash flow is just going to increase over time. So here in Texas, it being landlord friendly, you can expect, for something like this to have rent increases 100 to 150 each year. So even though it's very minimal, and this is for total again, so this is after you save accordingly for worst of the worst, you still are left with $10, but that's right now with the rents. You're not taking into account 5-10 years from now with $100 increases every year. So by that point, in a 3 or 4 year time, you can be on 200 to 300 for cash flow. And this is really good for a return on investment as well. So this is almost about 22%. And these are the tentative home prices that we've gotten from our builder connection there right now. So that's the Canyon floor plan that you saw, and that's at 275 starting. And then we go up from there to the Frio and the Rio being about at 290s and early 300s. So we've also had those as well. Those rent more and they are cost more. The 4 bedrooms also a really good appreciator over time. People love to have that extra bedroom. In the age of COVID, us moving towards working from home in the future, 4 beds appreciate very well. So even though Again, kind of using the model that we talked about earlier. Sometimes if the purchase price is a little bit higher, it's going to go higher over time. So don't see it as, dang, that's 30,000 higher. You know, if you have to pay 30,000 to make an extra 100,000 in the long term, you want to go for the options that you really believe in and that we know work. So those are the three options. I will send you guys all of the different property picks that we discussed on here and the information along with them. And of course, if you guys have any questions, you have our information, and Rachel will give you some more insight onto how to connect with us after the webinar. But I'll hand it over to Rachel.
Awesome. Thank you so much, Kian. That was great info, definitely. And speaking of questions, guys, I have seen quite a few of you sending some over. We just, because of time constraints, don't have the ability to dive into them individually tonight, but Kian and I will be reaching out tomorrow, so we'll definitely get back to you with answers to your specific inquiries. So just wanted to make sure you knew that we saw those. As far as what you can expect when working with an advisor, you can think of me like a concierge or quarterback if you're a football fan. Like I said, I am a licensed realtor, but for any market where I'm not the primary boots on the ground, then I will connect you with one of my amazing partners that is an expert in that area. Case in point, Kian. So we do quite a bit of work together, and when clients come to me, if they're investing in Central Texas, I can connect them with. So basically you start with why. The initial connection call, we sit down, take a look at your current situation, do goal setting, evaluate what you'd like to do. How, there's obviously many different ways you can get there. I have clients who are incredibly aggressive and want to expand their portfolio really quickly. I also have clients who have been around for 20 plus years that like to add a home every few years. So anything and everything in between, we're here to make it work on your schedule. When deciding on a time frame, you just have to know what's right for you. It's different for every investor, and we're just here to help connect the dots and connect you with the right resources to make it happen on your time frame. Setting your criteria. You can look at, Kian covered all sorts of different options that you can find in Central Texas. We can help you with that. Identify your market. Obviously, we have a large footprint in Central Texas, but we do have other out-of-state markets as well. We'd be happy to connect you with someone in the right market for you and introduce you to all the key players. Last but not least, here's my info one more time. I'd be happy to connect with you guys if you have any questions, get you connected with Kian. We can do a deeper dive on anything you may have. And with that said, thank you guys so much for joining us tonight. Kian, thank you for all that awesome info, and we look forward to talking to you guys soon. Hope everyone has a great night. Thanks, guys.
Thank you, Rachel. Thank you, guys.